And we have a very exciting lesson today. Ladies and gentlemen, we finally get to the SMC entry models. Now, up until this point, we've covered multi-time frame analysis, we've covered daily bias, draw on liquidity, and we've walked you through the process of going all the way from finding your higher time frame bias down to your intraday entry point of interest. And now we're going to go down to your lower time frame entry. Now, the way this is going to work, I'm going to present you with 3 different entry models that you can use that are all based on ICT concepts, and we're going to be ranking them from easiest to the most difficult. So the first entry model I'll be presenting you is a pretty beginner entry model, very easy to understand, and it also gives you a very high probability. Now, with that, it also does kind of limit you in terms of how far you can grow with it, but it is a good entry point for those of you just starting. This is actually the entry model that made me profitable when I was losing all of those accounts. So if it can make me profitable, it can make you profitable as well. It's also a good foundation for other more advanced entry models like the ones we're going to be going into an entry model 2 and entry model 3. So without further ado, let's get into the first entry model. But before we do that, we have to do a bit of a refresher. So if you remember this from the last lesson on multi-time frame analysis, as well as where do high probability entries form, this is our exact process that we repeat every single day to find both the higher time frame bias and our intraday point of interest. So for all of these entry models, we are going to be using the same higher time frame and the same intraday process. So unlike other strategies where they have to change up every single thing just for it to be a new strategy, with these entry models, you can actually use the same exact top-down analysis process. The only difference is the entry confirmation that you're actually waiting for. So make sure you have a good understanding of these two concepts, higher time frame analysis as well as intraday analysis, because this will be the foundation to the lower time frame entry model. And of course, once you've located your intraday point of interest, you drop down to the lower time frame. And what do? You wait for price to get to that point of interest. So if it's a 15-minute fair value gap, if it's a 15-minute order block, whatever it is, once price gets to that, this is what you're looking for. You're looking for a market structure shift that leaves behind a fair value gap, a order block, or both. And from all of the price action lessons, we know what a market structure shift is, and we also know what a fair value gap and an order block is as well. So by now, it should be very easy for you to tell when this happens. And what you're also asking yourself is there a clear displacement and a target of at least a 2R? Because as we've already covered, for a proper market structure shift, you do need a displacement. You need a strong directional move with high velocity in your specific direction. So if you got that, if it measures at least a 2R to your first target, which we also talked about, then you have yourself a trade. So if yes, then you can enter. If no, then you need to wait for more price action. So the lower time frame includes the 1 minute, and you're waiting for a clear and obvious displacement from your key intraday point of interest. So that's what you're looking to see from your point of interest, and the displacement must create a market structure shift that leaves behind a fair value gap, an order block, or both. Now, what exactly does that look like? Let's go ahead and take a look. And we're going to hop on the charts after this as well, so we can go over some of these examples. But I'm going to introduce all the entry models, and then we're going to hop on the charts right at the end. And the purpose for this is because within each New York session, we often offer up multiple of these entry models, each within the same session, some even within the same move. So we're going to go through all the entry models first. Make sure you understand them at a base level. Then we're going to hop on the charts, and I'm going to show you how to find each one within the live market. So what exactly does this market structure shift model look like? Well, the first thing you need is an intraday point of interest. So in this example, we have a bullish 15-minute fair value gap. Then we're waiting for price to trade into that bullish point of interest. So we do so there. What do we also do? We make a swing high. And we know market structure shifts, swing high, you make a low, and then you shift structure. So that's what we did here. We took that low, took that liquidity, as well as the intraday point of interest, and then we shift market structure, obviously, right there. Now, what did we leave behind? after this market structure shift to the bullish side? Well, we left behind a 1 minute fair value gap. So this would be on the 1 minute reacting to the 15-minute fair value gap. You can see we have that fair value gap right there. And now what you can do is place a limit order at that fair value gap, stop loss below this order block candle right here. And then you can also do a market order if you want to as well, but I like to do the limit orders. And your target must be a 2R minimum. In this case, we have a 2R to that high up there. And then you can see, boom, price reaches for that target. So it's a 3-piece combo. You're looking for 1, the sweep of that 15-minute fair value gap or intraday point of interest. You're looking for the shift in market structure that leaves behind a fair value gap, or order block, or both. And then you're looking for at least a 2R target to the next intraday draw on liquidity. And at that point, you have yourself the entry model number 1. And now we're going to move on to some nuances with this model. So cases where you don't want to actually enter this trade. And the first one is when it's consolidating and a point of interest. On our example previously, we had price responding from the 15-minute fair value gap. If it just chops around, you obviously don't want to take that. The second thing, no displacement. We talked about that in the price action lesson on basic market structure. If there's no displacement, there is no market structure shift. And there is also an extra confluence. If you have an IFEG that lines up with your entry fair value gap, we'll go over what that means when we hop on the charts and go over the example. And just as a refresher, if you do not remember the market structure shift, go ahead and take a screenshot of this, study it. This is the technical definition for a market structure shift. And next, we're going to go into our second entry model, entry number 2, which is the IFEG. So you're looking for an IFEG to form from a key intraday point of interest, same intraday analysis process, same higher time frame analysis process. So now you're waiting for that intraday point of interest that you've identified to get traded to. So similar with the 2022 model, you're just waiting for it to get traded into. You want to see generally the same pattern of the low, lower high, lower low, and then the market structure shift. Except this time, you're not necessarily looking for a full market structure shift, although it may happen. What you're simply looking for is for an IFEG to form, a fair value gap in the opposing direction to form. So in this case, this is a bearish gap opposing a bullish gap. Bullish 15-minute gap, 1 minute bearish fair value gap. After we sweep liquidity, after we trade into the 15-minute fair value gap, this fair value gap right here must get displaced and closed through in order to be a IFEG. And bonus points if it leaves a market structure shift in the process. In this case, we did not, but sometimes this candle is so high volume that it closes above the swing high. But all you need is for this fair value gap to get displaced and closed past. And then you have yourself an IFEG entry. Now, you can place your market order once the IFEG candle closes. So once this 1 minute candle closes, you can go ahead and click enter, stop loss below the order block candle or the IFEG candle. But on the other hand, you can also place a limit order at this IFEG, and sometimes price will retrace, tap this, and react off of it. Doesn't always happen that way, but in that case, you can also apply the same limit order concepts to this entry model. It also offers a target of a 2R, so we have met the minimum for that, and then price goes and hits our final target. So that is the second entry model. It is the IFEG, and you can see also how we had an IFEG, but we also had a 2022 right here. So that's what I was saying. When they both line up, that's even more high probability. And then for this one, it's pretty much the same nuances. You don't want to see it consolidating at that point of interest. You want to see an immediate reaction. If it wicks but doesn't close above the fair value gap, obviously that's not a true IFEG. It has to close past it. And if there's no displacement through the fair value gap, it is not a strong IFEG either. And like I said, extra confluence if you have a 2022 model that lines up with it, or vice versa. And we'll be covering this one on the charts as well. And you're going to notice some interesting things when we do this. You're going to notice that pretty much every time we have an IFEG, most of the time we also have a 2022. But other than that, we're going to go over our third entry model, which is of course the top and bottom tick model, aka the turtle soup. Now, This entry is the most advanced entry you can take because it doesn't require any lower time frame confirmation. In fact, it solely relies on your intraday and higher time frame analysis and your ability to identify the highest probability level. So the way this one works is once you're done identifying the point of interest, you're just placing a limit order at that level, stop loss at a fixed 10 to 15 points, targeting a fixed 3 to 4 R, and you can leave a runner for as many RRs as you want. But the reason I put this entry at the end is because the way I kind of worked my way into taking these entries is I started with the 2022 model. Once I got comfortable with that, I jumped to the IFEG model. Once I got comfortable on the IFEGs, I started noticing that every single level I'd identify, I was entering off the IFEG, but I could have got a much lower entry or a higher entry if I'm selling if I would have just not waited for confirmation. So that's when I started experimenting with this, but it wasn't until after I had mastered a full entry model first that I jumped to this mechanism. And I'm not saying you have to do it that way. Obviously, you can start with this model, but no matter which one you choose, my main point is master the higher time frame draw, master the intraday time frame and the way the draw and liquidity works on that time frame, and then entries honestly are going to be the least of your concern. But now let's go ahead and hop on the charts, and we're actually going to take a look at some examples of this. So right off the bat, we have an example right here. This is actually from one of the New York sessions this week. And you can see that price comes down in this 15-minute fair value gap. Now, what do you notice here after we touch that 15-minute fair value gap? What does it do, guys? It leaves a bearish fair value gap right here on the 1 minute. So that's a 15-minute bullish gap, 1 minute bearish gap. It's literally the exact example we were just going over. So in this case, what do we have to wait for? We have to wait for price to displace and close through that gap, which happens here. So you can see we finally make it through that gap. Obviously, this is a pretty big IFEG, so your stop loss would be pretty big on this position. But you can see if you left the stop loss below the fair value gap candle low, you can probably target up to a 2R. And then we'll see what price does from there. And then you can see it's a pretty extended run, but eventually we do make it up to that 1 to 2. Obviously, the stop loss was quite wide on this position, so you could have opted for a slightly smaller stop if you wanted to, but just to be safe, we kept the stop below that low. So we also have one down here the first time price reacted to this level, so let's see what we had going on there. Well, you can see we had the same thing. We had a IFEG here. So you can see an IFEG was made. At that point, you could have entered on this candle right here after we closed through the gap. Stop loss below the low. 1 to 2 was right there at that high. So that's just another example, guys. And then what else did we have? We had a market structure shift right here. Boom. Market structure shift. We also left some fair value gaps, this being one of them. And then what do we do from that fair value gap? Well, we also delivered up. So that is a 2022 model right there. It's a pretty extended one, but that is a 2022 nonetheless. And you can see it plays out for a nice 1 to 3 right there. So these type of setups are always happening. And even if you wanted to take a turtle soup or a top and bottom tick off that level, you could have either placed it at the consequent encroachment of that fair value gap, 10-point stop. Boom, you would have bagged your 1 to 3.6, 1 to 4 right there. And then you could have also entered off the actual fair value gap high. And then you would have still gotten your 1 to 4 there. So you can see all three entry mechanisms played out. Obviously, the lowest entry offered was right here. The second most efficient entry to the bottom was right there at the IFEG. And then, of course, this one wasn't as probable, but still, nonetheless, you were able to catch your piece of the market. So, like I said, guys, once you understand draw and liquidity, once you understand higher time frame direction, once you understand where the best intraday points of interest are, and you get practice with identifying them, the entry is just kind of like an afterthought. Like, it doesn't even matter as much as you think. What really matters when it comes to entries is stop loss placement, which is why I'm always telling you to place it below the swing lows, always telling you to place it below the fair value gap candle lows, and always telling you to place it in a strategic way. So that gives you the best chance of having a protected level. But ultimately, it still comes down to picking the right intraday levels, intraday draw and liquidity, and aligning it with the higher time frame and just using the lower time frame to catch the move in that direction. But let's see if we can find one more example for you guys here, so that way you can have these entry models in your arsenal. Let's see here. It looks like just a random setup, but this is looking like it offered something right there. So we've got a 15-minute fair value gap. Boom, we retraced to a premium, and you can see how well it respects that there. And in this case, we did not have... Actually, we did. So sometimes, guys, it will deliver from places without giving you a actual confirmation, which is why the turtle soup model is also good, because in the case where price leaves you behind, you don't necessarily have to get left behind if you're using the turtle soup model. So you can see right off the bat, that would have been a really nice level for the turtle soup. Stop loss was a little small compared to the fair value gap itself, but nonetheless, it did end up playing out. But what else do we have? We had way down here, that was a bullish gap, and it got inverted on this candle right there. So that, my friends, is an IFEG. So you can go ahead and take a sell after that candle. And in this case, you might not want your stop loss all the way at the high. So like I said, above the high of the IFEG candle, which would be right there. And then, of course, aim for a 1 to 2 or the nearest liquidity, which is down here. And that is a 2.7 R for that sell position. So this one didn't offer you a 2022 model, but it gave you a turtle soup / top tick, and it gave you an IFEG as well. So there's an entry right there. We also had one off, what is this level? The weekly wick consequent encroachment, which was a bullish level. And what happened off of there? Well, we have a 2022 model right here, guys. So the 9:30 open of this day offered a 2022. We came down into a weekly bullish level, super strong level there. We had a market structure shift after taking out that swing high there. We left a fair value gap. And what did we do? We traded into that fair value gap, and we ran higher up into what? Up into a draw on liquidity, being that 15-minute fair value gap. So this is always happening, guys, all the time. And once you know what levels price is reacting from, what levels it's likely to draw to next from an intraday, 15-minute, and then daily and weekly, all you got to do is line up yourself on the lower time frame to go ahead and ride these entries. And you can even catch them in multiple directions. You can catch a 2022, and then once it reaches here, you can wait for another reversal confirmation, IFEG, and then you're off. Or if you wanted to turtle soup, you could have turtle soup this level too, turtle soup this level as well. And there's just always endless opportunities happening all the time, guys. So it's really about going through and practicing this, really about just doing what I'm doing right in front of you, but logging your examples in an actual journal, logging your examples in an actual folder, organizing that, and then studying it and seeing which setup is most clear to you. For me in the beginning, the 2022 model was the easiest for me to follow. Right now, for what I'm looking for with my returns and my trading and just a set and forget style, the top and bottom tick is working super well for me. And there was a period of my trading in between where the IFEGs were kind of my bread and butter as well. So it's really up to you guys. Once you learn the draw on liquidity, higher time frame bias, you can literally switch out the entry models all the time, or you can just stick with one and master one just like I do. So I really hope you guys enjoyed this video. This should be super insightful for those of you who already have mastered the higher time frame bias, already mastered the intraday draw on liquidity, and are now just looking to hone in on the entry mechanisms. So if you have any questions, let me know in the comments down below. Also, comment day 24 complete. Have a blessed night, everyone, and I will see you in the next lesson.